Hello, Richard here on Thursday the 20th of January in 2011. 3 weeks into the new year, and we're looking at a chart of the US dollar weekly, which has traded off heavily with an outside week. This is an engulfing pattern that covers the previous week's bar, and we've got a short signal on the market forecaster which suggests clearly that there is weakness present. And where is it likely to target? Well, this long-term support is a potential. If that is the case, that we're going to see a big rally in the commodity currencies as well as gold and silver. But the wave count on the indices suggests that that's not likely to happen. So I know that's a contradiction, but the point is that we're seeing a consolidation here. This is generally seen as accumulation. So even though we've got the weakness now, the potential is that this is a wave 2. So we've got a pullback occurring, and we can measure those pullbacks by putting a Fibonacci on the weekly. It's a little bit more difficult, but there's lots of permutations for wave 2s. They can retrace 100%, or they can retrace this red line is a 61.8. So at the moment it's sitting on a 50% retracement of this move up, and even though this is a very bearish picture where the jury's just out as to whether or not we're going to get any significant move down. But I wanted to show you what's happening on the indices, because we've got significant divergence occurring between the two. This is effectively what we would term as 5 waves up from this, even though it's looking ABC there. We're very close now to our target, which we set way back here at 11,850. At the time we said, in the event that breaks through this resistance based on the Fibonacci extension on the measurement from here to here and down and up, we've got 5 clear waves up and an extension there of the 61.618. So it looks like after the big sell-off that other people are noting that. I think it was a few points shy, maybe 15 odd points shy of the 11,850, but nevertheless we're due for a correction. There's no doubt about that. I mean, this is just tracked up on a very grinding, gradual basis. Nevertheless, it has continued to go up. We don't have a signal yet on the market forecaster. This has been very accurate all the way up. It's kept us effectively in the trend. So in the event that we did get a big sell-off, well, this long-term support would be a logical place for it to support. Failing that, and we might get a bounce there. And indeed, if we're to get a meaningful correction, then it would push through that support line. But that's a way off yet. But I wanted to show you this gradual incline, so keep that in your mind's eye as we go to the Australian market, which even though the longer term trend is certainly up, it's been an absolutely grinding trade right from September last year. So that's 1, 2, 3, 4 months of sideways activity, even though the bullish or buoyant sentiment is out there within the Australian context, and certainly from just about every economic indicator, given that we're one monstrous quarry at the moment, digging out our resources at pace, that one would have expected to see a higher retracement. Let me just go to the weekly chart to show you. Hopefully that will come up reasonably clearly, but it just gives a good overall context of what's occurring. And you can see that, and I'll go back to the Dow just to show you as well. You can see what's occurred here is that in April, I called this the end of the phase 2 of the bear market, meaning that this run from the high to the low, which was the GFC, and then the retracement, it has pretty much been done. It's been a while since we've measured that, but you can see that that the Australian market made 50% retracement of the GFC down, and it did that in April last year, called that a top, and since then we got the flash crash, of course, but since then we've ground up in what looks to be an ending diagonal. That is when you get these lines closer at the top than you do the bottom, and you know, even though we don't have on a weekly chart, we don't have a signal, and haven't had since what's that? We haven't had a bearish signal since June 2010. So I'm sorry, the first bearish signal was obviously April, and that's when we called the top at 50%. And since then, yes, exactly, we haven't had a bearish signal since around June 2010. So we've had this for, you know, best part of 7 months now, this grinding upward leg. So just going back to the daily, and I'll quickly sweep back to the Dow so you can see that. There's the long uptrend. Let's go to the weekly chart to put that in perspective. It's a bit messy there, as we've got a number of notes that have been written over time. But there is the retracement of the GFC, and also remember, if you can see in the mess here, there is the April sell-off, which of course our market exceeded, but of course we are down here. So in fact we've only retraced something like 61.8% of this April to June low, but whereas the Dow has come up in 1, 2, 3, 4, 5 very clear waves and hit our target of 11,850. That doesn't mean it can't go higher. Clearly it can. We've still got, from a weekly perspective, we are long on the market force. So that's worth just watching, because you know, at those levels we would expect, given that it's gone through the 61.8, we'd expect some sell-off in the near future. Having said that, let's go and have a look at the Australian dollar quickly, and there's the dollar. You know, we've had this big double top here. You know, that clearly was our run up to the highs. That's just about, I think it is the record highs, or highs for over 30 years anyway, at 2 cents above parity. It then on the weekly, this is a daily chart, ran short and tested this long-term rising trend line, breaking through it, and then since then it's been hitting it from underneath. So what that means is that the support line is now resistance, and yesterday's and early this morning, I think it's still trading on this candle, you can see here that it has really got the makings of a doji star. Just traded off a little bit now. The potential is, and we're looking for weakness in this to trade down towards, and I'll put an extension on to give you a guide as to what that could be. From a Fibonacci perspective, first target would be the low, which would be 98, followed by 96.30, 96.29, 96.30, and if indeed this is the beginning of a one down, an ABC, which is a correction, up for 2, then the wave 3 projection would be down to the 50 moving average, and that would be around the sort of 93.5 cent mark. But that's yet to be confirmed. It's not to say it can't go higher, but it's certainly setting up in terms of the technical structure for a push to the downside. Let's just see how much it's retraced up to give you a feel. It's come up on this particular leg down. If this indeed is the first leg down, it's come up 61.8, or just fractionally under percent. Really strong reach up to try and get it, and then failed, and now is sort of rolling over. Let's have a look at the euro. The euro looks something different because the weakness is still there, even though since just before Christmas we had these, you know, really fantastic swing run up, which was the Santa rally. It certainly didn't get back up to the resistance. You can see this long-legged doji here, which is a reversal, and then the sell-off. We didn't see any of those candles, although this is a hammer, which is a reversal signal at the end of the run-up, and it is trading very heavily down over 1, 2, 3, 4 days. It really hammered down very, very quickly in a solid trend, and then reversed and has taken back all of those losses, and now is looking for further direction. So on the market force, clearly we're still long from a daily perspective, and what we'd hope to see is either some renewed highs, or it will track, in fact probably lead, based on whatever the US dollar index does. The point being is that if the US dollar index continues to sell down, if you remember that chart, then this euro will continue to trend up, and who knows, may even test this 1.38 again. But at the moment we're sort of in no man's land after a solid rally up. This is 1, 2, 3, 4, 5 waves complete. You know, I wouldn't be surprised to see a solid correction to the downside, an ABC, before you know, we get a feel for where we're going from here. So moving on to just to give you a quick look at silver. Silver's this is a weekly chart. There's the upper reach of the trend resistance. Will it hit it exactly and then trade it off oh so heavily? Big outside day. That's a bearish engulfing pattern, and indeed the market force, after running up so convincingly for, you know, so many weeks, you know, that goes back to August 2010, before it completed, well, the first time in June 2010, and then it's sort of gone sideways a bit. So testing this secondary support resistance line. If it breaks through, then all bets are on that we'll be tracking down towards this support line at around 22. Sorry, this is the material sector. We're on the Australian market, and this is the materials, so BHP and Rio. You know, the trend is most definitely still up. Remember that the ASX 200 is sort of going sideways, so here are the market makers, these ones, you know, pushing this market up. So that's the materials, and indeed the financials is always worth looking at. Now yesterday we had this bullish candle here, which is broken through this long-term support resistance, and indeed this intermediary trend line, downward sloping trend line, which it's broken through. We've got a long signal on the market forecaster. You know, it's been long for a few days, 1, 2, 3, 4, 5, and you know, if that indeed does continue up, then perhaps this will become support. If the broader market is continuing up, which is, the jury is most definitely out of that because of that 5-wave situation, then we're likely to see a bit of down. This is a daily on gold, triple top, 1, 2, 3, down, wave 1 up to 2, and now will this continue? Wave down for 1, up for 2, down for 1, up for 2, down for 1, up for 2, and eventually grinding its way down to our very long-term target, which is 1262. That's been in place for some time. You can see that from a market short force perspective, it's been short since excuse me, the 31st of December. 31st of December. So it has been, you know, working its way downward. This trend line now is obsolete, and we can take it off, but it certainly did its job and showed when it broke through with great style. A big down day. I think that was not a record, but very close to it in terms of its breadth. So final chart on this fairly long video is oil, and you can see that oil has been tracking up and hitting its resistance at $92. People are calling for 100. If we go to the weekly, just to get a feel for where that is, similar to what we did for the S&P 500, the Dow we looked at, you can see that it is currently hitting, it's a little bit of noise in there, but it's currently hitting $90, which is the 50% retracement of the great bull market and then subsequent sell-off. There's absolutely no doubt it could continue to track up, could even track up to the 61.8, but that would mean all the indices are moving upwards, and indeed the oil is tracking the Dow. In fact, it's moving slightly in front of it. It seems to be a little bit of a crystal ball as to what's going on, but from a daily perspective, you can see that what is interesting here is that this looks like an inverted, a short-term inverted head and shoulders pattern. So here's the head, there's the left shoulder, there's the right shoulder. So if this is the case, and we saw movement up here and a break of this neckline, then the way to measure that to get a feel, as an example, is as follows. You take a line to the neck. It's easy to do this on e-signal. We copy that, drop it up, and there's your target, which effectively is just a tad below $98. But that is just what I've noticed now, so we'll see what happens here over the next few days. If this tracks down, then obviously that head and shoulders, inverted head and shoulders, is a failure, and we're pushing down in line with the rest of the indices, and all towards the 85, 86 mark. Alright, well that's it. That's a long video for today. Thank you, and we'll talk to you early next week.